This episode of the Accounting Insiders podcast is brought to you by Insightful Accountants Be Insightful membership program. Get 9 expert-led training tracks, over 30 CPE hours a year, hands-on workshops, and year-round premium content to grow your skills and your practice. Learn more at blog.insightfulaccountant.com. Just click the premium member content button.
Hello and welcome to day one of this month's tax-focused Future Forward webinar series. Today's session is what OB3 means for the filing season of 2026. My name is Emily Frowles and I'm the host of today's session. Our presenters are John Sapp, CPA, and Taylor Rodier. John and Taylor are going to walk through the OBBA and explore the bill's key tax provisions and provide practical insights into how these changes will impact tax administration, return preparation, and client advising in the years ahead. Before I turn the event over, though, I have just a couple of housekeeping items and some information I'd like to share with you. First up is a quick poll. So Matt, if you want to throw that up real quick. Have you heard about our Be Insightful premium content and our 2026 cruise? In July of 2026, we are hosting a 7-night Caribbean working cruise during which you will have time to work on your business in sessions that are curated and led in such a way that you will walk away from the cruise relaxed and with a strategy and execution plan to grow your business to the next level. This is part of our Be Insightful community and training program, in which we offer 9 training tracks, including tech step, app comparisons, migrations, HR, marketing, business development, and others, led by some of the top trainers in the profession. Members have access to more than 30 CPE credit hours per year, workshops, and a variety of year-round premium content. If you want to learn more about the program or the cruise, please click yes on the poll and we'll send it to you. Now, next item, this webinar is CPE eligible. You must be present for 50 minutes. You must answer at least 3 poll questions. And if you meet this criteria, we'll send you your certificate within 48 hours. If you have questions during the webinar, please add them in the Q&A. You will receive an email following this event with a link to the archive, which will be posted to our YouTube channel. Matt will drop the link into the chat and the slide deck as well. Lastly, after the event, we'd appreciate if you would answer the short survey that will pop up on your screen. And I will now hand it off to John and Taylor.
Thank you. Thank you all for joining us today. We are very excited to talk to you about this huge piece of tax legislation. Let's see. There we go. We'll skip through this since we've already been introduced. Our learning objectives today, we want to understand the legislative path that the One Big Beautiful Bill Act took through Congress. We are going to identify some implementation challenges, review key tax provisions in the bill, and evaluate the policy and political implications of the bill for the coming filing season and beyond. So this is just a look at our agenda today to give you an idea of how we're going to get through all of this material. I do want to make a quick note just before we get started. Throughout this presentation, you'll hear us refer to the bill as One Big Beautiful Bill or OB3, but we wanted to let everyone know that we were notified very late in the game for this particular presentation that Treasury and IRS are beginning an effort to rebrand the bill as the Working Families Tax Cuts Act. So you may begin to see that name, and I may refer to it as that a few times throughout this presentation because it's a learning curve for me as well. So if you start seeing that name in the media or in IRS publications or whatever, just know that that is in reference to what has been called the One Big Beautiful Bill to this point, and they're trying to rebrand that. So that's not a new bill. That's not something different. That is this bill. And isn't that 2025 for you? Just throwing another curveball close to filing season.
You know, the unique thing about this bill, and one of the reasons that I love doing these with you, Taylor, is you have that insight behind the doors. Like, I think Treasury just mentioned that in one of your conversations on Friday, that they're going to, quote, rebrand the bill. I think it's a very poignant thing to think about. I don't remember that ever happening. I was here for the 1986 Tax Reform Act. You could tell from that introductory slide. I have a few years on Taylor. But Taylor brings this perspective that you don't get in a lot of tax seminars. And that is those types of conversations with, number one, how did this bill get passed? And why is that important, right? I mean, because the things we're dealing with today are directly related. They go back to how this bill was passed, right? And so anyway, pretty excited to have this conversation.
Me too. We're also going to be, I'm about to start discussing the political context in which the bill was passed. I just want to make a note also that I do this so that we can understand the policy objectives and political goals of the bill. I'm going to give you my good faith observations, and I hope that you'll be patient and understand that these are not my opinions. These are just the unbiased facts on the ground of how this was passed. So to begin, with the political context of OB3, now the Working Families Tax Cuts Act. If you tracked this, the development of this legislation at all, you'll know that there were delicate negotiations, contentious exchanges, and political horse trading up until the very last minute to get this bill passed. The onus behind passing a bill of this size was the trifecta that resulted from the 2024 general election. So, in addition to returning President Trump to the White House, the election resulted in Republican majorities in both the House and the Senate. So, the Trump administration and Republican Party writ large have referred to this as a political mandate from the American people to swiftly enact the president's policy priorities. The easiest way for Republicans to do this when they have majorities in both chambers and they control the White House is reconciliation. The budget reconciliation process is a special procedure in Congress that allows tax, spending, and debt limit bills to pass the Senate with a simple majority of 51 votes instead of the usual 60 that is required in regular order. So this is just the most straightforward way to pass major legislation on a party line basis when you have majorities in both chambers. This gave Republicans a way to advance the Trump administration's legislative agenda without any bipartisan negotiations or compromises that most legislation in regular order requires. And even with only slim majorities, the GOP could meet the necessary thresholds in both chambers to pass this huge legislation. So to get an idea of what that process looks like, it is not easy. It is a long process, lots of negotiating up until the very end, especially for OB3. Reconciliation starts with a budget resolution that's passed by both chambers. These set spending and revenue targets for the committees that are going to be drafting legislation for the bill. Then the legislation drafted by committees has to meet those targets, and then the committees pass their legislation on to the budget committees in both chambers to combine the work into one bill. The One Big Beautiful Bill's path to becoming law started in the House. So the House cleared OB3 for a floor vote. Then Speaker Johnson added a manager's amendment to appease certain wings of the GOP that were not satisfied with the bill in its form prior to that. One of those amendments he added was the increase to the SALT cap because he wasn't going to have the votes necessary to pass if he did not. So he did that at the last second. Then the House passed OB3 with a simple majority. It went to the Senate. Vice President Vance broke the tie in the Senate to pass the law 51-50 on July 1st, and then it was signed into law by the president on July 4th. So we saw Republican leaders really driving a lot of OB3. They have several things that they have to accomplish to get a reconciliation bill passed. The most important is complying with Byrd rules. So Republican leadership, Speaker Johnson, Senate Majority Leader Thune, all the way down to committee chairs had to ensure that all legislative measures in the reconciliation bill could comply with those Byrd rules, which you may or may not have heard of. These were designed to restrict measures in reconciliation bills to make sure that these are only used for budget-related measures, so spending, revenue, or debt. Any provision that is extraneous can be expunged from the bill, either via a challenge on the floor or unilaterally by the Senate parliamentarian. That's a pretty unique situation that really only arises during a reconciliation process. Provisions are ruled extraneous if they have little budgetary impact or if that impact is merely incidental, or if they increase the deficit outside of the budget window, which is normally 10 years. So in the case of One Big Beautiful Bill, the parliamentarian did rule that some Medicaid changes were extraneous, so they were stricken from the bill just as an example. They also had to negotiate and manage different factions in the GOP. Especially Speaker Johnson has a particularly raucous conference this time around. So he has a few people who like to be contrarian, I'll say. Broad spectrum of political ideology in the House Republican conference. So he had to balance a lot of competing priorities and attitudes, knowing that he could only afford to lose a handful of votes. The Senate posed a different challenge, reconciling priorities of members facing reelection every 2 years in the House who need quick wins to show their bases. It's very different in the Senate where they have 6-year terms and more room to delay or take a longer view. So getting both chambers to pass identical legislation is always a struggle, but was especially apparent in this process. And then, of course, the fight over the state and local tax deduction, whether to maintain that, increase it, knowing that it's costly. That was a big problem as well. And then, of course, they have to meet the administration's goals. The whole point of this was to pass as much of the Trump administration's legislative priorities at once as they possibly could, give the Trump administration an early win. And so that was the biggest part of this reconciliation process to begin with. And I think we're ready for our first polling question.
Well, you ask real polling questions, not just what's your favorite fruit.
I didn't know that was an option, but I would love to know everybody's favorite fruit. That would be way more fun.
Taylor, do you believe that the way the bill was passed? I don't think, you may have said this, I don't think any Democrats voted for the bill. Is that accurate?
That's correct.
So do you think that increased animosity? I'll give you a polling question. Do you think that increased the animosity between the two parties, or decreased it, or had no impact because it was so bad anyway?
I think everybody knew that if Republicans walked away with the trifecta like they did in 2024, that reconciliation would be the first thing they did when the new Congress opened. So I don't think it did anything to negatively impact relations between the two parties, because I think it was just kind of a foregone conclusion. It does mean that whatever the outcome of this bill is long term, it can't be blamed on Democrats. It can only be blamed on Republicans if it doesn't go well, or if it doesn't work as well for the American people as it was meant to. We know legislation comes with unintended consequences all the time. So Republicans will own that completely, which is politically risky. Let's see. Okay, so our polling answer was, of course, the reconciliation process. And it looked like pretty much everybody got that correct. So we will move on. I'm going to turn it over to John to talk about key tax provisions in the bill.
Okay, so I'm going to hit these tax provisions quick. As most of you know, there were a lot, and they're all over the place. It wasn't just one particular issue that I think if Congress had started the legislative process, it would have been much different. I think Taylor could probably be smarter about this comment than I'm going to make it. But because of the fact that Trump was running for president at a time, Trump is a president, or he's a leader that does things quickly and he does them, I won't say off the cuff, because I think there's a lot of strategy behind a lot of the things that he does that potentially he doesn't like people to see. But some of these appeared to be one-off type things that just showed up all of a sudden. And then we all kind of, I thought, well, that's never going to make it through Congress because there's no way to implement those things. And then all of a sudden, here we are. So now we are dealing with things that, we're going to run through just some of the high points here real fast. So the tax brackets, the big message with our tax rates is, they were set to go back to higher amounts pre-TCJA in 2026. They are going to stay low in the brackets themselves, where folks will flip over to particular brackets, are going to stay low also. So instead of a 39.6 bracket, we'll have 37% bracket. And then, of course, the lowest bracket at 10%, still going to be in that $24,500 range. Our standard deduction, most of us know that itemized deductions are much less utilized than they were 5 years ago. The standard deduction was set to go back to $8,800, and that particular, the standard deduction, was one of the driving factors, along with I think just Republicans not wanting to be seen as the ones that let TCJA expire, and so get hung a tax cut around, or a tax increase around their necks, being the party of quote unquote lower taxes. But they were set to go back to the standard deduction was set to go back to about $8,800 for married filing joint in 2026. And it is set to go for 2025 to $31,500. In addition to that, we also have a deduction for seniors. Whatever the motivation was for that, it's an additional $6,000 senior deduction per eligible individual senior. So if both husband and wife are over 65, that's a $12,000 additional deduction for seniors. It does phase out at $150,000 for married filing joint. And they have to be 65 or turn 65 before the last day of the taxable year. And they also, if they are married, they have to file a joint return. And that's in several provisions. There was no married filing separate option for that to happen. Child tax credit, this was something that, was passed as part of a precursor bill that never became law back in January, I believe, whenever they were trying to get some extensions done on the TCJA. But the big message here, 2026, child tax credit was set to go to $1,000 with a max $1,000 refundable. Now the non-refundable child tax credit is $2,200, with $1,700 of that being refundable. There is a Social Security number required now for taxpayer, and for either the taxpayer or the spouse, and the qualifying child Social Security number is required to be happen. The other interesting thing that happened with this and a couple of the other deductions is there is now math error, this expansion of math error authority. And I think there are so many tax provisions that that were part of this bill that a lot of times the math error authority expansion for the IRS to be able basically to adjust a return and give the taxpayer a very short 30-day window to reply if they disagree to their adjustments, as opposed to the normal audit rights if there was some type of, which is a 90-day window, I believe. So that math error authority, they will be able to have more control, especially over the Social Security number aspect of this this bill. And then of course the other dependents, the big thing that didn't change there is the I-10s are still okay for the taxpayer or the spouse in order to get the other dependent deduction of $500. We also saw just a couple other things, casualty losses. Those were made disaster areas permanent. They'll get expanded eventually to include state declared disaster areas. And for educators, there's a 900, there's a definition of 900 hours for who is an educator. But now the $300 deduction per taxpayer and spouse, so a total of $600 for married filing joint, which was for non-itemizers. Now there is an ability to take a miscellaneous itemized deduction in 2025 for unlimited expenses. So if educators itemize their deductions, there is no limit to the amount of educator expenses that they can take. We also, the P's limitation on our itemized deductions was set to come back next year. It is not coming back, but basically they've rebranded that as a 2% deduction, 2/37 of the lesser of the amount of itemized deductions, or the 37% tax bracket. There's a calculation there that we're not going to go into today. The two items that probably got the most attention from the press anyway was, number one, the no tax on tips. And the big message that was an above the line deduction right below, they called it an above the line deduction because it's for non-itemizers. But for us tax folks, it's a below the line, above the line. So it's where QBI lives, and that QBI deduction. So it's below the AGI calculation, but it's above taxable income calculation. So it's not technically an above the line deduction, but it does show up and have that impact without changing the AGI numbers, which a lot of the states were requesting that potentially if there was a way to do that. And there's a whole lot of guidance I say a whole lot, there's at least some guidance that's been issued by the IRS on what's a tip. And you have to start out with identifying the occupation code of the taxpayer. Are they working in home services, hospitality? Are they in transportation? All of those types of things. And then the IRS actually released an addendum to that included, barbers shops and hair care salons and nail care. Anybody that customarily and regularly, as of the end of 2024, was receiving tips can qualify for the tips. This particular deduction runs from 25 through 28. And, it's a maximum reduction of $25,000. So it is enough to make it very interesting for folks that are inclined to receive tips, or maybe they would like to stretch the rules a little bit. So it's something we'll have to pay a lot of attention to as we prepare their tax returns. There's not going to be any changes on the W-2s. Now for 2026, we'll see a box 12 code that'll show up for tips. We're not going to see that in 2025. And you're also, the other thing just to be aware of is the definition of tips. So it has to be a qualified occupation, and then it has to be a qualified tip. It has to be something that is voluntarily given, not a service charge. For those that have large groups and they charge 20% surcharge, that is not included in the tips. So if we go through all of the requirements for this, there was a panic in the W-2 reporting world. Said, how we haven't been tracking this, how can we do it? Because it starts January 1st of 25. And the IRS basically has said, we're going to give transition relief, and they've done the same thing for overtime, that any reasonable method of tracking those tips, they're not going to challenge it. Now, they don't specifically say we won't challenge it. They said it is acceptable to have any reasonable method. And of course, we all know that the definition of reasonable is what is going to probably what's going to be the bug in the ointment. Let's put it that way. And it's going to make all of us a little bit nervous as we do that. Just as interesting is the no tax on overtime. And I see the question there, how are you going to know if tips are voluntary or just that's where it is going to be a reasonable method? And we're going to have to just say, if we look at Circular 230, which gives us the due diligence standard of if we have no reason to believe that a particular answer the taxpayer has given us is wrong, then we can rely on information provided to us by the taxpayer. That, coupled with the fact that I believe most employers will probably make an attempt to do that, but just realize that allocated tips do not qualify for this either. So no tax on overtime is just as interesting. And the for 25 through 28, same thing as tips. And this is up to $12,500 per taxpayer and spouse. So it's $25,000 for joint filers. And basically says that qualified overtime comp, that the taxpayer can deduct the pay that exceeds their regular rate of pay, such as half portion of the time and a half compensation that is required by the Fair Labor Standards Act. I don't mean to go down a rabbit hole in our political conversation, but you read the Fair Labor Standards Act, some of you guys deal with a lot of payroll, and you know that most of that entails what has to be included in the base rate. So for example, commissions that are paid, holiday pay sometimes can be included in the base wage. All of those things, if they're included in overtime, could actually lend itself to be additional overtime pay. The bill doesn't spell it out. And so what we're going to have to do, I believe, in this tax season is rely on IRS guidance. At this time, it appears from what they've said that it's going to be halftime. So for example, some industries will pay double time if somebody comes in on a holiday, potentially even more than that if they work more than a certain amount in a day, 8 hours. It appears as if, and the two arguments there are, because the OBBBA says that overtime comp paid to an individual required under Section 7 of the FLSA that is in excess of the regular rate. That's all OBBBA says about that. So the two arguments could be, is it required to be paid? And that would be limited to time and a half. So that would limit it to the halftime. Or is it required? And if it's required to be included in overtime, then that would be all premium pay based on work hours. So anyway, just be aware that that is definitely going to be something that we're going to have to figure out probably as the car is running down the track during tax season. No tax on car loan interest, pretty straightforward. Loan has to be obtained after 2024 for personal use. And that deduction is $10,000. All of these go together on the same schedule, 1A this year. So no tax on car loans, interest, the senior deduction, overtime and tips all go together on the one schedule. And the last one that I'll just bring up here, because I think we'll probably have a question about it pretty soon, is the SALT limitation. And as we all know, this was the headline tax change that the big fight was about. It's interesting to me that it's not part of the shutdown conversation. That's all around premium tax credits having to be repaid, and the 400% of FPL qualifying for the premium tax credit. But the SALT limitation was $10,000. The OBBA is making that $40,000 in 2026, and an additional 1%. I'm sorry, in 2025, the SALT deduction is going to $40,400 in 2026. And then it's going to go up by 1% a year. And in 2030, it's going to go back to $10,000. All of that is probably about 40% of the individual changes at a high level that we're going to see. And I think on the next slide, we have some of the business changes. Taylor, is there anything in there that I missed or something that I did too much of that you think we should be talking about?
No, I just want to note, because there's a question in the Q&A box. The extensions here are the TCJA extensions. That's what the slide is showing you. The other OBBBA provisions that you just talked about, those individual new provisions, they're not here because they're not TCJA extensions. I just wanted to note that because I think someone was a little confused.
Did I go off script?
No, you didn't go off script. You're fine. Here's the business provisions.
And the one thing I'll point out here is the bonus depreciation, of course, which was made permanent at 100%, but it's only for property acquired after January 19th of 2025. We get 100% bonus depreciation. Anything acquired before January 1st and January 19th is 60%, which was the phase out percentage that was supposed to happen for the whole year. Taylor, what's the significance of January 19th? What happened there?
January 19th. Oh, that would be the inauguration.
That was inauguration day.
Yeah.
And the first time I've ever seen a tax provision that was tied in to inauguration day. We do see the R&D credit, where if you wanted to go back and apply the expensing to be able to either amend returns, or if you wanted to go ahead and take full expensing over unamortized amounts, you could make that election by July 4th of 2026, and July 4th was the date that the bill was passed. And the rest of
my birthday.
it really doesn't surprise me. that you would be born on July 4th, as involved in politics in our government as you are. And I don't know if we want to talk about the Trump account here, or if we're going to talk about Trump account in a minute, Taylor.
We can talk about Trump account here if you would like to.
So I know it's not a business provision, but it is something I think that all of our tax returns this year, you're going to want to, anyone with children, you're going to have the opportunity on the tax return to opt that child into a Trump account. There'll be a new form that we have a draft of, but we can't say it, show it publicly. What is that form number? I forgot what it was, Taylor.
Form 4547.
4547 will be the new form. It's basically a new type of IRA, operates more like a Roth. It is not a Roth for taxpayers for children under age 18. Annual contribution limit of $5,000. Contributions are not deductible. Employers can contribute. Probably the thing that is garnering the most attention at this stage is the pilot program, where the government, for any child that is born in 2025, 6, 7, or 8, so from January 1st of 25 through January 1st of 29, the government is going to place make $1,000 contribution to that taxpayer, to the taxpayer's child, I should say, unless the child's parents or guardians opts them out of that account. Now, this year it's going to be a little tricky, just because it is going to have, one of those children that qualifies for that $1,000. They're going to have to check a box to opt. You're going to have to check a box for your clients to opt them in to the account. But eventually that'll go to the opposite, where those kids will be opting out of the account, we think. Now, whether you can opt out, whether the government can set up an account legally, I think is still kind of being debated, without the taxpayer actually saying, yes, you have my permission to set up the account. But for this year, you will opt a child out if they don't want the $1,000. Any child born before 2025, is going to have to opt in to get the account set up so that it can receive contributions. What we don't know is how taxpayers are going to be notified the account's been opened, how taxpayers are going to make contributions to the account, and even what bank it's going to be at. We don't know if it's going to be at a bank. It could be at a brokerage. So we'll see, and that's all TBD at this point.
Yes. Let's see.
This is a great little calculator from the Tax Foundation that we found. And you can go out to the Tax Foundation's website, and basically we pulled 2 of their scenarios, which showed that, a married couple with 2 kids making $85,000, they're going to see roughly a 3.5% increase in their weekly pay if you took the total tax benefit divided by, this change in home pay. I don't know that, Taylor and I were kind of debating it earlier. I don't know that we agree with having, that calculation unless we see withholding tables that are reflecting that. So all of this calculation is all in number 2680, and they have the very detailed calculation. And then you even see the single folks that even get a bigger benefit at that lower income level. So there are tax cuts to be had up and down the spectrum, both at the higher incomes and at the lower incomes levels here. And there's a very detailed calculation on their website that I thought was really cool, that they were able to put that out fairly quickly. We also are giving you, and when you get the links to your slides, you'll kind of see this, the changes in the tax forms this year. And I didn't know until last year when someone from the IRS told me that the Assistant Treasury Secretary approves the 1040. And some of you may say, well, who cares about the 1040 anymore, because we are electronically filing everything. Well, and Taylor, I don't know if you have any thoughts about this. I'd be really interested to hear your thoughts. But just from a historical perspective, whenever, I forget which year it was, when tax simplification was a really big deal, the way that was exemplified by the Treasury Department was we had a postcard for a 1040 form, and that's where we got schedules 1, 2, 3, and 4, because all the information on the 1040 was pushed off to a schedule. And I think we've seen some of that in this particular tax form. Taylor, I don't know if you have any thoughts on what the 1040 could teach us based on what's on there.
Yeah, I think the United States is very interesting in the way we do our income taxes, and we use our tax regime to influence the behavior of the citizenry, and we see that throughout history. Recently with the IRA, we saw a lot of green tax credits and electronic vehicle tax credits, things like that, because that was a priority of the prior administration. We saw TCJA before that because that was a priority for Trump 1. And so I think when you look at the 1040, especially when there is big tax legislation that's passed recently, you can kind of get a feel for what the current administration's tax priorities are. And that is definitely pretty clear looking at the 2025 1040.
And if you think about immigration as an issue, I think that is signaled on the 1040. So for example, just below the spouse's social security number, I know it's a little small on the screen, you'll notice that you check here if you and your spouse filing a joint return and you lived in the US, and then you'll notice under the dependents although it was always a requirement, now on the 1040 we see check here if you were in the US, and in box B there. Check here if you lived with you for more than half the 25, yes, and then and in the US is also there. So we see that kind of reflecting hey, we're doing a lot on illegal immigration because we're asking these questions on the 1040. It's also reflected there. And those are the big changes. The other changes on the front there, I think, are signaling things the IRS potentially we may see show up in examinations in the next few years. And those are things like our tax exempt interest, and all of these were already on the return on lines. I can't really read the specific lines there, but all of those lines were already on the tax return detail, but they weren't on the 1040. And now the tax exempt amounts are showing up on the 1040 itself. So I think that reflects the fact the IRS is probably going to use some technology to flag things that appear out of line. So tax exempt interest, big contributions and those kinds of things. So
While we're here, I just want to flag for everyone watching that you can grab this draft and drafts of tons of forms on irs.gov. They put draft forms in a section of their website. It's very easy to find if you just Google IRS draft forms in case you want a closer look at this or want to mark up a copy or anything like that. But this is back.
A great point. Yeah, so I think that you can work your way through the form yourself on your own once you get our PowerPoint here. But very interesting to know that the 1040 is a very political form, and it does show the political prioritizations of the administration, of whichever administration is in office at the time.
Okay, here is our second polling question about the SALT cap increase. So we'll give you a minute to fill that out.
I don't think I mentioned, Taylor, that the newborn $1,000 just has to be U.S. citizens, right? I don't think I mentioned that either until we started talking about immigration here. So the U.S. citizen, and that money is not going to be deposited to the taxpayer until, what was the latest date that they gave us on that?
Yes, I think it's next July 4th is when they'll start making those deposits. Again, there's a lot of infrastructure related to the Trump accounts that I don't think is settled completely as of yet. So it will be interesting to see the guidance that comes out, but they are really depending on the tax filing process this coming filing season to get people at least started, and definitely to spread the word a little bit more because sometimes people are just not aware when big changes like this happen. I know we have to keep track of it, but a lot of people won't have any idea that Trump accounts are a thing. They can sign their children up for it until they go file their taxes this season. So it'll be interesting to see what numbers they come up with following the filing season. Okay, I believe we can move on. The salt cap increase was $40,000, and again, it looked like most people got that question correct. So we will move on to some implementation challenges that we foresee with OB3. I think so. To begin with, IRS readiness and administrative barriers, we have staffing shortages already. We are in the midst of a government shutdown right now. Prior to the government shutdown starting, there were lots of reductions in force and deferred resignations that were started basically as soon as the Trump administration took office. We had the Doge wave for several months in the beginning of the year. And now we are seeing where the IRS tried to keep all of their staff on through the shutdown because the shutdown lingered and is still ongoing. We have additional furloughs that have happened. So we already have an organization that had been reduced by about 25,000 staffers, now further reduced. And we're also seeing some additional reductions in force that are going to take place as a result of the shutdown of about 1,400 to 1,500 people. At the same time as they're trying to implement this huge new tax bill, we have gaps in tech modernization. So they're trying to balance keeping up with those goals and keeping up with implementation of this bill on a very tight timeline, given that we passed the bill into law on July 4th and tax season starts traditionally in January. And then we have bureaucratic coordination and leadership gaps, given that the Treasury Secretary is also the acting IRS commissioner, and now we have a new IRS CEO, which is a position that has quite literally never existed before, and several acting, one confirmed IRS commissioner prior to this. Just a lot of changes at the top, a lot of leadership positions that are either vacant or only have an acting official in that capacity right now. So there's a lot happening between IRS and Treasury.
Why in the world would they say we're going to put a CEO in there and not just appoint a new commissioner?
Because the confirmation process for an IRS commissioner is quite involved, and I think it's fair to say it did not go super well the last time around. Um, you know, I I met Commissioner Billy Long. I thought he was a very interesting individual, but he did not have the smoothest confirmation process. So I think it's easier for them to create this new CEO position so that the CEO can work very closely and monitor day-to-day operations at IRS without having to undergo confirmation. Although they did choose someone who is already in a confirmed position. So he has gone through Senate confirmation because he's the current commissioner of the Social Security Administration. So it's not as if it's an unknown individual. But Senate, particularly Senate Democrats, would like to have their day to hold a confirmation hearing, and they're not going to get to do that. So that's my 2 cents on that, at least. And then we do see, some risks and vulnerabilities incoming with the filing season, especially implementing a bill of this size with laws of this complexity. Um, we could see, and we already are seeing, quite frankly, misinformation out there about the new deductions. We anticipate people who are perhaps less informed about the difference between a deduction and a credit, expecting to see all of the tips that they've made throughout the year as part of a refund or something like that. We anticipate definitely some fraud related to Trump accounts, or at least attempted fraud related to Trump accounts, because it's so new and there's so little guidance and it's not clear how it's going to work. And that's something that fraudsters really like to take advantage of. So it's going to be really important, especially with the transition assistance that IRS is offering, that everybody just kind of stay on the ball and try to make sure that clients provide as much supporting documentation as they possibly can when claiming these new deductions and credits and things like that.
So does this mean that we will have no, well, you go ahead and do your polling question. I'll ask you a question while we're waiting
This
on
is, yeah, just the third polling question.
So here's the question for you.
Mhm.
Does this mean, because I saw a lot of the layoffs were in uh, small business, not, I keep wanting to say W&I, but it's not W&I,
LB and I believe.
LB&I, LB&I. So, which is where most of our audits will live and do live, notices and all those types of things, especially for small businesses. So does that mean we don't have to worry about audits anymore, that we're not going to have any because they fired everybody doing those?
I don't think it means that we won't have audits anymore. I do think that the GOP and Trump administration are moving away from the Biden administration's audit goals, where they wanted to decrease audits on people that were making $400,000 or less. I think the Trump administration is just far less bullish in general on IRS audits. That type of enforcement is not something that the administration has any passion for. I think the goal for the Trump administration and Treasury Secretary Bessent and others is just to make sure that the IRS functions well in terms of collecting revenue and dispensing refunds. I think they want to keep customer service up at the level that it has been, although I think they will have some difficulty with that this year, given all of the rifts and deferred resignations and hiring difficulties. But I don't think that auditing is as big of a goal for the Trump administration. Not that it won't happen, just that it's less of a marquee kind of initiative.
I did feel as if an arbitrary, I think it's $400,000 number, we're not going to increase audits for anybody making less than $400,000. You know, to think that Trump is the only politician to ever just come up with something in the tax administration on off the cuff would be misleading, because I think the previous administration did the same thing with that $400,000 arbitrary number. Basically said we're not going to increase audits. Instead of making audits based on the accuracy of the return, they were going to select folks for audit based on their income level, which I was not aware, and I'm still not aware of that ever being done before. Was it made? You know, I don't think a big deal was made out of it, but publicly anyway. But in my mind, it was a line that was crossed, that not a legal line, but at least an unspoken line between tax administration and tax policy.
Right. Okay, so that polling answer was all of the above, and it looks like most people got that correct. So our final section today is going to be about the policy and political implications of this bill. We are definitely going to see some impacts on the 2026 filing season, especially due to complexity. This filing season will be a proving ground. Taxpayers may experience more complexity at first, while practitioners have to quickly adapt to new forms, rules, and guidance. And the season's success will strongly shape perceptions of the bill. Tax preparers will have to do their best to perform due diligence checks when many of the individual deductions, like tips and overtime, may not have been reported regularly throughout the year. That's why that transition assistance the IRS is offering is so critical for this year. And then these changes to the Internal Revenue Code are big, but they're temporary. So they represent heavy administrative lifts and significant changes, despite the fact that they're only effective in tax years 2025 through 2028. Their future beyond 2028 is uncertain, but I think a popular idea right now is that these deductions, particularly deductions on tips and overtime, and the senior deduction, will be popular, and the next Congress or administration will want to extend those, just like this Trump administration wanted to extend TCJA. We'll also see different taxpayer experience this filing season, especially with those new Social Security number requirements to file for certain deductions and credits, like John was discussing. There's also new rules about filing jointly if you're married to claim certain deductions and credits, which may be surprising to some taxpayers who are married but have filed separately in the past. We're expecting longer wait times on IRS phone lines because of major workforce reductions, and they're struggling to fill and train customer service positions for the season. And then we're also going to see this paper check phase out related to the president's executive order. So direct deposit information is being added to more forms in the coming season. Details about the implementation of that order are expected soon, but this may be a difficult transition for taxpayers who are unbanked or underbanked or are just wary of providing bank account information to the IRS for whatever reason. And then there's enough material to do a whole different webinar on state taxes related to OB3, but those changes, particularly related to healthcare, will have impacts on state budgets, which adds complexity to the debate that states have about conforming versus not conforming to the federal tax code. And then we have implications for tax professionals. And since Mr. Sapp is a tax professional himself, I will let him discuss this.
So I love the comment that Jay has made in the Q&A, that it seems as if our tax season is going to be extended again. Yes, that is correct. Our summer is going to be impacted. We're going to have folks that are gathering the proper records and documents that they're going to need. You know, you couple that with things like we saw the IRS this year's, or at least last year, start litigating around charitable contributions the last 3 or 4 years. So we have to make sure all of those are documented correctly, and then we have to make sure all the overtime, at least we have a reasonable method to our madness on why we took a particular deduction or why the taxpayer took a particular deduction, all of those and tips, because all of that's not going to be automatically reported. So I think really to start planning now, do you have a reasonable method that you can tell your clients, I believe this is a reasonable method for ensuring that your tips or your overtime is calculated in a particular way? Do you believe that, what's your due diligence going to look like? I think go ahead and thinking about that now, even if you don't put it on paper, so that you're ready for tax season. You're not surprised and every new exception is not popping up and causing you additional time as you figure out how to deal with it. And I would go ahead and start my tax planning. That little calculator. I'll give a merciless plug for Drake. We were within a matter of weeks after the bill was passed. We had our tax planner updated within our software, so you could actually see that working if you'd like to within our software, and start modeling outcomes for your clients. So, but if you're not using Drake, I'm sure your software is probably by now. It's been several months, so they're probably slower than we are. Probably not quite as accurate. No, I'm just kidding. But all those, go ahead and start planning for those tax scenarios for your clients now. And then delayed implementation and resources. We're going to see, as Taylor already mentioned, and this is not surprising to any of us, reduced phone service. I don't see that there's a way that money is going to be freed up to just hire a bunch of people. Then you have to train them. I think the big question is going to be when tax season will start. And Taylor, I don't know if you have an answer to that question yet. Sorry, I don't mean to put you on the spot. Normally when I ask her, she will say it will start in 2026.
Yeah, it will. That much I can say for sure.
I don't think it's going to push. Well, I'm not even going to guess when it's going to start because I've been surprised before. I haven't heard any talk, and Taylor, maybe you can tell me, several years ago, we started the tax season, but you weren't able to file certain itemized deduction returns. You weren't able to file certain credits. I haven't heard any talk about a limited beginning to the season. Have you?
Yes, I have heard that there is a possibility that some returns claiming certain things may need to be held until a later date. So again, I have no official guidance on that. I just know based on other calls that I've been on that they may have to do something like that this season. But I do know that they want to start in January. There was kind of a gaffe made by the former Commissioner Long that it would start in February, and I know that it's the IRS's every intention to start at some point in January. So I will say that for what it's worth.
The good news about that is if we can get started early, of course, we potentially don't have as many returns to do after the filing deadline. So with that in mind, the last thing, just be ready to adjust because things are going to change 100%. I will guarantee that everything we think we know today, there will be some things that are going to throw curveballs at us that we're all going to roll our eyes. And at the end of the day, our clients are counting on us to get the correct answers into their hands. And we at Drake are working diligently to help you do that. And, we do regular updates. So that's why we have folks like Taylor that is very embedded within the government process and has lots of input into how that occurs. One of our most intelligent and insightful voices that we have. And you get the benefit of that, right? And so Taylor will help craft our communications whenever the relevant things happen, such as when tax season is going to start, and is it going to start fully, or is it going to start later? Those types of things. So,
we have one final polling question for everybody. While we're talking, or while we're doing this last polling question, just for everyone's awareness, if you have been hearing news about the government shutdown but aren't super tuned into what exactly is going on the ground right now, this is the 20th day of the shutdown, so this makes this current shutdown the third longest in American history, which is a fact that a politics nerd like me would like to know. So there you go. There's your fun fact for today. There is not a workable deal in sight as of this morning to end the funding crisis. So the central issue that's caused the shutdown is the expiring ACA enhanced premium tax credits. Of course, that's super relevant here to this audience. So these were introduced in 2021. They made more people eligible for subsidies, including those with incomes above 400% of the federal poverty line, and increased the amount of this credit that for those that were already eligible. So this enhanced premium tax credit expires at the end of 2025. This is for people buying health insurance through the ACA marketplace. So the expiration of these credits is something that is untenable to Democrats. So they have been blocking the House passed continuing resolution funding patch that would last through November 21st. I believe Senate Democrats blocked it for the 11th time, or are expected to block that bill for the 11th time today. So that's where we're at. Again, completely possible that guidance and stuff is delayed for OB3 from IRS, given that they're working with such a depleted amount of staff. So be on the lookout for news about the shutdown, because you're going to want to keep up with that. It's going to be very difficult to get in touch with, if anybody has normal contacts at IRS, it will probably be very difficult to get in touch with them. Phone lines are going to take a long time. All of those things. So that's the state of the shutdown.
and there's a lot of calculators out there, especially by health insurance companies, that show the impact that that's going to have. And you say, well, why would the health insurance company care? Why would they promote the marketplace as a place to buy health insurance? Well, it's private health insurance, right? It's just administered and to some degree paid for by the government through the premium tax credit. Family of four, 400% of the FPL is about $130,000, $140,000 in most states. I think, it's on a state by state basis. But one of the estimates I saw, if a family of four at 80,000, if the premium tax credits are changed or expire the way that they are contemplated right now, then potentially that monthly premium for health insurance goes from $280 paid by the taxpayer, I should say. The premium itself doesn't change. It goes from about $300 to almost $600. So it's almost going to double it. I think I'm not sure what the percentage was, but it was a pretty substantial percentage that just not having that premium tax credit. It will probably see a lot of folks fall out of buying health insurance at that point if that were to happen. So I don't think anyone really has the appetite for that, but I don't think they're going to blink on the shutdown. I think that's what you told me, Taylor. So I don't mean to say I'm thinking that. I'm only thinking that because I think that's what you said.
Shutdowns are about who blinks first, and nobody's blinking right now. So I think we're just about out of time, but if anybody has any questions, feel free to pass them along to us and we'll do our best to get an answer for you. I don't see any questions in the Q&A box that have not been answered. So
Awesome. Well, thank you, John and Taylor, for your very informative webinar today. And thank you to all of our participants for being here. Don't forget, we have 3 more Future Forward sessions this week. Tomorrow is the Tax Ready Bookkeeper. Everybody have a great day.
thank you.
Are you an accounting or tax professional who wants to stay ahead without spending a dime? Join thousands who trust insightful accountant and tax practice news to keep them informed and empowered. Get expert updates on QuickBooks, Xero, tax planning strategies, and workflow tips delivered straight to your inbox. Whether you're a solo bookkeeper, firm leader, or tax advisor, these newsletters are your shortcut to what's next in the profession. They're free, practical, and built for people like you. Visit insightfulaccountant.com and hit subscribe to start your smarter workflow today for free.